You've probably noticed that public companies are holding billions of dollars in Bitcoin, right? Well, that number is growing, and it's growing fast. So if you're a financial decision maker, this is a trend you absolutely cannot afford to ignore. Today, we're going to show you exactly how the pros track these corporate crypto stashes, a skill that's not just useful anymore, it's essential. First things first, let's just get a handle on the sheer scale of what we're talking about. This isn't some niche experiment by a couple of tech companies anymore. No, this is a fundamental shift in corporate finance. Just look at this number, $91 billion. As of late 2025, that's the value of Bitcoin just sitting on the balance sheets of public companies. To put that into perspective for you, that is more than the GDP of some entire countries. It's an absolutely staggering figure, and it shows you just how seriously corporations are taking digital assets. And that $91 billion, it's spread across more than 200 public companies. When you add it all up, they hold over 1 million Bitcoin. That's about 5% of its entire circulating supply. A huge chunk. So that really begs the question, right? With so much at stake and all these moving pieces, how do you actually keep tabs on it all to inform your own strategy? Well, that is exactly what we are going to break down for you. All right, here's our game plan. We'll start with where to find the data you need. Then we'll walk through a step-by-step process for tracking it. After that, we'll get into how to use this data to build a really smart financial strategy. And finally, we'll cover why this is more critical right now than ever before. Let's get started. Okay, let's dive right in. To track corporate Bitcoin, you need the right toolkit, and it really just boils down to two main categories of data sources. On one side, you have the official, legally required SEC filings. This is your ultimate source of truth. And on the other side, you've got these specialized tracking platforms that pull all that data together into easy-to-use dashboards. Here's the key. You really need to use both. So the gold standard for verified data is, without a doubt, the SEC's EDGAR system. This is where public companies are legally required to disclose their digital assets in their annual 10K reports, quarterly 10Qs, and so on. Think of it as the official record straight from the horse's mouth. And here's a little pro tip for you. When you're digging through those super dense SEC documents, search for this exact phrase, investment in Bitcoin at fair value. It's the standard language they use, and it'll take you straight to the numbers you need. It's going to save you hours of searching. Now, for a faster, big picture view, these platforms are just indispensable. CoinGecko is fantastic for its wide coverage and its automation tools. BitcoinTreasuries.net is great because it gives you that valuable context, like what the company paid for its Bitcoin. And Bitbo.io is awesome for quickly seeing which data has already been officially verified. They basically do all the initial legwork for you. So the big takeaway here is simple. Trust but verify. Always, always cross-check the data from these platforms against the official SEC filings. In a market this volatile, you need data that's updated daily, and you should always stick with platforms that are totally transparent about how they get their information. Okay, let's get our hands dirty and see how this all builds into a reliable tracking system. It's actually not as complicated as it might sound, especially if you follow a clear process. We can break the whole thing down into three pretty straightforward steps. First, you find the companies holding Bitcoin. Second, you confirm the data is accurate. And third, you create a dashboard to monitor it all. First up, you've got to identify the key players. A platform like BitcoinTreasuries.net is a perfect place to start. You'll immediately see the whole spectrum of strategies, from an all-in company like MicroStrategy, which holds a mind-boggling 660,000 Bitcoin, to a company like Tesla, with a more cautious but still really significant position. Next, you confirm the numbers. Go right to that company's latest 10K or 10Q filing to get the official figure. Then you have to convert that Bitcoin amount to a dollar value. And the key here, this is super important, is to anchor it to a specific point in time, using that day's price. That's the only way to account for the volatility. And finally, this is where you bring it all together. You create a dashboard to track the key metrics that actually matter: total Bitcoin, its current dollar value, what they paid for it, and the unrealized profit or loss. You can even automate the updates using an API from a service like CoinGecko, but you still got to remember to schedule those regular manual checks against new quarterly filings. Now, this isn't just an academic exercise in collecting data. Not at all. The real payoff is using this information to make smarter, data-driven treasury decisions for your own organization. Once you have the data, you can start to see these patterns emerge, these different strategies. You've got the Bitcoin first companies like MicroStrategy, where it's a core part of their entire business model. Then you have those using it just to diversify their treasury. And, of course, the miners who stack it as part of their operations. Understanding these different approaches is absolutely key to benchmarking your own. And let's be real, a core part of any strategy is assessing risk, and this chart is a pretty stark reminder of what's at stake. Bitcoin's volatility is just legendary, with these massive drawdowns in some years and then explosive new highs in others. Your treasury policy can't just hope for the best. It has to be built for this exact reality. So you can then take all these insights and apply them directly to your own policy. Seeing what others in your industry are doing can help you set reasonable allocation targets. You can develop KPIs that are actually specific to digital assets. But critically, and I can't stress this enough, you have to establish clear governance and controls before a single dollar is ever invested. So, we've covered the what and the how. But let's get to the most important question. Why does this matter so much right now? Well, it all comes down to one major change that's about to shake everything up. The reason is a new U.S. GAAP accounting rule, and trust me, this is a complete game changer. It's effective for fiscal years that begin after December 15th, 2024, and it is going to fundamentally alter how companies report their crypto holdings. You see, under the old rules, companies reported Bitcoin at what they paid for it, and they could only mark it down, never up. This new fair value rule flips that on its head. Now, a company's Bitcoin holdings will be valued at their current market price every single quarter. That means all the gains and all the losses will flow directly to the bottom line, which is going to make quarterly earnings reports a whole lot more volatile. And this massive shift from historical cost of fair value accounting leaves us with one critical, forward-looking question for every single financial leader out there. As Bitcoin's wild price swings get wired directly into quarterly earnings, the stakes are higher than they have ever been. So is your balance sheet and your strategy truly ready for that ride?